It's Friday, the 29th of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, forget Mexico, Canada, and China. Here's one potential big winner from Donald Trump's trade crusade. But first, Neil Shearing joins me once again to rake over the coals of a week in macro and markets and look ahead to the coming week. Hi there, Neil. How are you going?
Hi, David. All good. How are you?
Good, thanks. Let's get straight into it. We've got to start with that Trump social media post from the start of this week. We can't call it a tweet, can we? It was, I don't know what you call them on Truth Social, but did it give you 2016 flashbacks?
It did, I'm afraid. That feeling of waking up in the morning, flurry of alerts on your phone and seeing that tariffs have been threatened on, in this case, Mexico, Canada and China. It did all feel very 2016, didn't it?
It did, and I'd be tempted to say it was the first salvo in his coming trade war, but really he was targeting Mexico, Canada, China, but talking about migration flows into the US north and southern borders and flows of fentanyl from China through Mexico into the US. He then posted on Truth Social that he'd spoken to Claudia Sheinbaum, Mexico's president, and that she agreed to close the border and basically stop those migration flows. Easy as all that. It fits in, though, doesn't it, with this idea that perhaps all this talk about tariffs is just a negotiating ploy on the part of the incoming administration. But it won't be as easy as all that, will it?
I don't think it will, no. I mean, there's a danger here, isn't there, of over-interpreting one or two social media posts. And I think one of the lessons from the first Trump administration is that we shouldn't do that. There'll be lots of posts on social media over the next 4 years, and some of them will be a prelude to changes in policy, but many of them won't. So don't overinterpret one or two social media posts. I think perhaps one of the most significant things for me, at least, was the fact that the threat of tariffs was tied to a particular policy outcome. In this case, as you say, restricting migrant flows and restricting flows of fentanyl into the US. And the reason I think that's significant is that there's two reasons really that you might want to impose tariffs if you're the Trump administration. One is to extract concessions out of your trade partners, and another is to raise revenue that you can use to cut taxes elsewhere. And in this instance, it seems to be that very much the former is the threat of tariffs in order to extract concessions, as I say, on migration and on fentanyl flows. So potentially a sense here that tariffs are going to be used as a tool to threaten and coerce trade partners into helping the US government achieve other objectives rather than as a tool for raising revenues more generally. But set against that, as I say, we shouldn't overinterpret one or two social media posts and the follow-up to those.
But there is also, though, this idea, isn't there, that, the threat of 10, 20, 25% tariffs on these countries is part of the negotiating ploy. Scott Bessent, the incoming Treasury Secretary, talks about escalating to de-escalate. Does it, with all that you've said, does it imply that there are deals to be done and that actually tariffs may be a short-lived thing and that we end 2025 with tariff levels not much higher than they are now, and that all this talk of a new trade war turns out to be a bit overblown?
Well, possibly. I think these things are always possible. I think the critical thing really comes down to, as I say, will tariffs be used as a mechanism to raise revenues, government revenues that can then be used to cut taxes elsewhere? Or are they going to be used as a tool to coerce America's trade partners and put pressure on them to cede to the US in other areas of policy? My sense is actually this time we probably will see tariffs go up relatively early in the Trump administration. It's the one policy that has been consistently advocated on the campaign trail. It's something that all of the cabinet, at least those with any economic brief, seem to be behind. And of course, in the first Trump administration, they spent much of the first year trying to repeal Obamacare. That meant that some of the other objectives in the economic arena got bogged down and pushed to one side. There doesn't seem to be that there's going to be these kind of big policy challenges like trying to repeal Obamacare in this forthcoming administration. So it wouldn't surprise me if we get tariffs quite early on in the Trump administration, forced to use an executive authority. But how big those are and how wide-ranging those are, I think that it's fair to say that is up for debate.
Yeah, our working assumptions for 2025, and we will be talking a lot more about 2025 next week, but our working assumption is that we're looking at higher tariffs.
Yeah, that's our working assumption, but it really is that, a working assumption. I think anyone that tells you it's going to be this tariff on these products, on these countries, is being disingenuous. So we've made a series of working assumptions, and then based on those scenarios, we look at the impact on the US economy and the global economy. And really, I think the outcome to all of that is that we're going to have a jump in US inflation. So potentially, if we get 60% tariff on imports from China and 10% universal tariff on all other imports to the US, that would push US inflation up towards 3% by the end of next year. But really, that's a level shift in prices in the US, and then inflation comes back down in 2026. So we've started to factor these into our forecast, but as I say, they're really just working assumptions right now.
Yeah, and we will have much more on the world in 2025 next week. But let's move on. I wanted to turn to China because we've just seen long-end Chinese government bond yields fall below JGBs. I've been trying to find the earliest references I can to this idea of the Japanification of China's economy. There are warnings going back more than a decade about parallels between what's happening in China's economy, China's growth model, and what happened to Japan in the 1990s. How far does this comparison go? How fair is this comparison?
Like many of these comparisons, I think it's reasonable up to a point. And the fact that Chinese bonds are now trading through Japanese bonds will lead many, I'm sure, to make this comparison again over the coming days. But I think the differences are almost as important as the similarities. So similarities, obviously, very low rates of inflation in both countries, weak rates of growth or weakening rates of economic growth, and large debt loads too. But I think the differences are critical as well. Japan's problems emerged after the bursting of a really large asset price bubble in property prices collapsing, causing all manner of balance sheet strains and problems and tensions in Japan. And in China, it's not really property prices that they're collapsing, but it's more of an overbuilding issue. There's too much supply of property rather than property prices being inflated and then collapsing and causing balance sheet problems. And of course, when Japan experienced its problems with deflation, it's much, much richer than is the case with China. So per capita income's not far off the US when Japan started to experience its problems, but in China, still 30% or so of those in the US at market exchange rates. Different periods of economic development. So some similarities, many differences. And my advice would be to view each case on its own merits, really, because I think trying to draw comparisons between the two will not necessarily provide much insight.
And these are long-term structural issues. I know we spent a long time talking about them, but nearer term, it does seem as though things are looking a bit brighter for China's economy. Our China activity proxy's been out. The latest reading's been out in the last few days. Talk us through what it says about the near-term outlook.
Yes. So our China activity proxy is our own in-house measure of economic growth in China. We've been running this since, I think, 2007. So it's got a long back history. In fact, I suspect it's got one of the longest back histories of any of the independent measures of economic growth in China. And we've recently just expanded the measure to include even more of the service sector in China. And what that's showing us is that, on the one hand, economic growth in China is weaker than was the case a few years ago. So just under 4.5% year-on-year growth in October. But there's been a bit of a cyclical pickup. So the growth has picked up since the summer months. So I think you can read all of that in two ways, depending on whether your glass is half full or half empty. There's been a bit of a cyclical pickup as some stimulus measures have started to feed through. But economic growth undoubtedly is a lot weaker than was the case several years ago. So it looks to us like trend growth in China is something of the order of 4 to 4.5% now. I suspect there will be further cyclical pickup in growth over the coming months and quarters as stimulus measures continue to feed through. And we've had more rumors on Chinese social media over the past day or so that there could be more fiscal expansion coming down the track. But those structural problems, as we've talked about on this podcast, continuing to weigh on long-term growth in China, and 4 to 4.5% trend growth in China becomes 3.5 to 4%, I suspect, in a few years' time, and maybe as low as 2% a year by the end of this decade.
Before you go, I just wanted to ask about US payrolls. It's the big release for the coming week. 190,000 is our forecast for November. That would be a pretty meaty month of hiring for this stage in the cycle, wouldn't it?
Yes, at face value, but there's an awful lot of distortions in this data. Remember that in October, payrolls increased by just 12,000. And the reason, in our judgment, was that that number was affected by two things: the effect of hurricanes and the effect of the strikes at Boeing. Now, difficult to put a number on all of that. We thought it might have pulled down the headline rate of payrolls growth in October by about 90,000. Since then, we've had state-level data, and we can see a pretty chunky fall in employment in Florida, which of course bore the brunt of the hurricanes, and in Washington state, where Boeing is based and obviously was affected by the strikes. So some support to the idea that hurricanes and strikes were responsible for that big drop to a 12,000 gain in October. When we look at what's happened to the labour market more generally, the surveys are painting a really mixed picture. The ISM Composite Index suggesting that employment growth is pretty strong. The PMI Composite Index suggesting that employment growth is extremely weak. We think that underlying employment growth at this stage is about 100,000 a month. Add on some payback from the hurricanes and the Boeing strikes, and we get to a figure of about 190,000 for November. And then I suspect dropping back to something like 100,000 or so in December. So lots of noise in the payrolls data, which the market's going to have to try and look through.
That was Neil Shearing on payrolls, China and Trump. I will post the relevant bits of analysis in the podcast notes, including our new analysis on how tariffs work and a recording of a drop-in, that's one of our short-form online briefings that Neil and the team held on Tuesday just after that Trump post. I'll also add our revamped China activity proxy. That data is now viewable and downloadable in a nifty interactive dashboard. Neil mentioned the PMIs. There's more in the coming week, including the Caixin manufacturing one for China and ISM manufacturing and services for the US. Look out for our coverage of those alongside other key releases like Australian GDP, Canadian employment, and German trade. And for clients who are going to be in London in the coming week, do come along on Wednesday to our live event all about what to expect in macro and markets in 2025. It's a chance to meet the team, get your questions answered, and do a bit of networking too. Get in touch for details or find them on the website. Now, as I mentioned at the start, a lot of the attention since Donald Trump's election victory earlier this month has been on those economies which look most vulnerable to aggressive US trade action. But some are likely to benefit from the fallout of an intensified trade war, not least India. Shilan Shah, who leads our India coverage, has been looking very closely at the implications for India's economy of another 4 years under Donald Trump. And I spoke to him earlier this week on what to expect. Welcome to the weekly briefing.
Thanks for having me, David.
We've spent a lot of time, haven't we, over the past few weeks talking about the potential global losers in Donald Trump's second term. We're only a few weeks away from Inauguration Day, and it seems we haven't spent enough time talking about the potential winners. On that basis, talk about what another 4 years of Trump looks like from India's perspective.
Yes, I think this has become something of a sort of regular talking point in our conversations with clients recently. There's particular interest in India and how it might fare under Trump's second term. And I think there's a couple of points to make. The first is if we get a universal tariff of 10% on US imports, which is our working assumption, it would probably have a small impact on India. It's not especially reliant on demand from the US. It might knock 0.2 to 0.3% of GDP growth when in the context of an economy that's growing by 7% isn't really that much. Where I think the story becomes more interesting is when we think about more specific targeted measures. Trump has tended to view trade policy through the prism of trade imbalances with the US. That's why he has threatened China with a 60% tariff, for example. Other emerging economies that run very large surpluses with the US include the likes of Mexico and Vietnam. So for corporates who may be thinking about relocating production out of China and into other low-cost economies, that's something that they're going to need to bear in mind. And the good news, I think, for India is that it runs a very small trade surplus with the US. So when we think about who might be singled out for very strict measures, then India is some way down that list. India is also politically pretty closely aligned with the US. Trump and Prime Minister Modi at least tried to portray a friendship of sorts in Trump's first term. So for me, it stands out as a potential beneficiary from firms wanting to shift their supply chains.
So moving supply chains or productive capacity out of at-risk countries like China and India benefiting from that, it comes down to this buzzword friendshoring, doesn't it? It's one of these words that gets bandied about a lot. Still feels like it's more hype than reality. Is that the right take? And if it is, I mean, how could that whole trend evolve under Trump?
I think we're at the point now that we can see some evidence of friendshoring. So I think it has gone beyond the hype. But what's important to highlight is that it's probably only really been evident in certain sectors of manufacturing. In India's case, that's been in high-end manufacturing. So over the past few years, its global share of exports of mobile phones and semiconductors, for example, has surged, albeit from a low base. These industries really were non-existent up until a couple of years ago. They're still very small compared to China, several magnitudes smaller, in fact. But there is real clear evidence of India gaining market share, and everyone's pretty well versed with story of Apple, for example, moving its production out of China and into India. And that is now something that is bearing fruit in the data. However, there's really been no evidence of this trend of friendshoring happening in more low-end, more labor-intensive manufacturing sectors, including in things like textiles, furniture, or in toys and games. Now, if we get this 60% tariff targeted at China, this could give India a real boost in its attempts to become a major manufacturing hub. When we think about what happened during Trump's first term and the tariffs that were applied on China, then a weaker renminbi offset almost all of the impact of the tariffs. But the depreciation in the renminbi that would be needed this time around would probably be politically unpalatable. Chinese exporters also have limited room to really aggressively cut their prices in local currency terms. About a quarter of manufacturing firms in China are now loss-making. So what that means is when you're operating on such thin margins with those tariffs, that production could shift elsewhere. And that's why we think that potentially it could lead to a broadening out of this friendshoring process within India.
We've had a very positive long-term view on India's economy. Certainly, it predates Trump winning the US election. How is that view shaped by this potential shift of manufacturing into India at the expense of economies like China?
Yeah, very much feeds into it. It's not the sole story. I mean, India's fundamentals from a long-term perspective look really, really strong. It's got very positive demographics, which, when we compare it to somewhere like China, but also other parts of East Asia, is a real boon for the economy. India is still a very poor country in per capita terms. That gives it enormous scope for very rapid catch-up growth. There's been significant progress in terms of the reform agenda over the past few years, in particular, boosting infrastructure. And really, that's something that sits alongside this idea of friendshoring. If you're able to have those basics in place, and then you get this relocation of supply chains, then that really underpins why we are still positive on India's long-term prospects.
But just on this immediate trade issue, is there a risk that we're being overly optimistic? Robert Lighthizer, Trump's former USTR, may or may not have access to the Oval Office in this second administration, called India, quote unquote, the most protectionist country. And I know before we started recording, you noted that Trump has called India the tariff king. I know you said that India's trade surplus with the US is relatively small, but is it nonetheless, given the mood music around US-India trade, is there a risk that we're being too optimistic in seeing all of this manufacturing move into India, and that actually will get caught up in this new trade war?
Yeah, I could throw one more into the mix as well. Trump on the campaign trail this time round said that India was a serial abuser of tariffs as well. So you can add that to the list. Clearly not escaped criticism from Trump or potential to members of Trump's administration. If Trump were to go down the road of sort of reciprocal tariffs, then yes, India could potentially suffer. The average tariff on US exports into India is much higher than vice versa, particularly for certain items such as dairy, medical devices, and pharmaceuticals. But yeah, as we mentioned, Trump has tended to view trade policy almost in more simpler terms, really, and that's through the prism of trade imbalances. And because of this small trade surplus that India does have with the US, I think that shields it quite considerably.
Before I let you go, our colleague Shivan Tandon has a new report out explaining why we're relatively bearish on Indian equities. Given all that you said about this potential of India's economy to benefit under Trump, our long-term bullish view on India, is there a tension here? Is there a contradiction with how well we think the country is going to fare in Trump's second term and beyond? And the fact that, contrary to the rest of the market, we actually don't think Indian equities are going to do very well.
So I think it's important to distinguish here between the long-term economic outlook and the near-term drivers of equities. So for the past 3 years or so, Indian equities have really been a surefire bet for investors that are looking for strong returns. The big picture more recently is that the local equity market, the Sensex, is down around 7% off its all-time highs. So my colleague Shivan looked into this, and we've now made the case that alongside signs of slight cool down in economic activity in the near term, some tighter regulation around retail investment activity, but also very stretched valuations, we think that further falls in Indian equities are likely over the next sort of 18 months or so. We're forecasting the Sensex to end next year around 5% below where it is now. Now, just to give that the context, that would represent a pretty significant underperformance relative to other major benchmark indices.
That was Shilan Shah on India under Trump, and a flavor of our new analysis on why Indian stocks are set to underperform. There's a lot more in Shivan's report, including valuations of large cap versus smaller to mid cap stocks. I'll post that report in the podcast notes. And that's a wrap for another week. We will be back next week with our take on the world in 2025. Forget the avalanche of year ahead outlooks. These are the handful of macro market themes you need to be paying attention to. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.